Welcome investors to my channel Fiscal Voyage. My name is Felix. So in this video, we're going to do a stock analysis on Sherwin-Williams company. This company has been growing earnings at 19% over the past 10 years. And they've been growing dividends for 15% for the past 5-year average, and their most recent dividend increase was 18% in February this year. And they've been growing dividends for 42 consecutive years, so make sure to watch the video because you may find this very interesting. And if this is your first time visiting my channel, make sure to hit the subscribe button and like the video because I'm doing a Dividend Aristocrat series. All the companies that are considered Dividend Aristocrats which have been growing dividends for 25 consecutive years or more. So make sure to subscribe to see tomorrow's video of the next Dividend Aristocrats that I'll be covering. Alright, here's a stock analysis on the Sherwin-Williams company, ticker symbol SHW. The company is an American Fortune 500 company in the general building materials industry, primarily engages in the manufacture, distribution, and sale of paints, coating, and related products to professional, industrial, commercial, and retail customers, primarily in the North and South America and Europe. The company is mostly known through its Sherwin-Williams paints line. A side note here, I actually, when I ever do painting projects on my home or businesses, it's always the Sherwin-Williams paint because they are the high quality paint. It's pretty expensive, but they're the best of the best paint. A lot of times it's just one or two coat and beautiful colors, and I always use Sherwin-Williams paint. Just FYI. So we look at the fundamentals for this company, and also something to consider. This is a very simple company. There's nothing exciting about it. Sherwin-Williams is, basically sells paints, so it's really, watching paint dry basically. But however, fundamentally, this company is amazing. From 2010 to 2019, revenue grew at 9.7 compounded rate annually. Net income grew at that same time period at 14.3%, which is outstanding. And S&P credit rating of BBB. Operating income grew at 14.1%. And here's the kicker here. Earnings in this 10-year period grew at almost 20% at 19.3%. So that's something like, wow, when you look at a paint company growing revenue, net income, earnings at this great rate. So it has been consistent. And even the 5-year average, the past 5-year earnings has been growing at 17.3%. So it's not the 19%, but it's still, high double-digit rates. Net income for the past 5-year average is 10%, and revenue has been growing at 12.1% for the past 5 years. So we continue with the fundamentals. For 2019, the company had adjusted earnings of $21.12. Net margin came in at 8.6%, which is higher than 2018 fiscal year of 6.3%. So net margin, they increased it slightly by 2%. Return on equity is real good with a 5-year average of 67.7%. However, this is something unattractive here, is the current dividend yield at 0.92%. But the company makes up with it with a 15.5% 5-year dividend growth rate, which is outstanding. And the most recent dividend increase was in February, a few months ago, where they increased it by 18.6%. So it wasn't in the initial phase of the lockdown, but it was kind of there. The news were coming about with the virus and such, but they were able to increase the dividend at 18.6%. Also to consider, the 5-year dividend yield average is 0.94. So the current dividend yield is right around the 5-year average. So that's a pretty good indicator that it may be fairly valued. However, the dividend payout ratio is very low at 27%. So they still have a lot of room to continue this high double-digit growth rate for the dividend. So increase the dividend yield. And they've been growing dividends for 42 consecutive years, which is outstanding. The charter rule gives us a 16.4, which is mostly from the 5-year growth rate of 15.5. That's why we have a charter rule of 16, so that meets our criteria of 11, 12, and higher. But again, I don't like that current dividend yield of 0.92, but they do make up for it with the dividend growth. So we look at the balance sheet for Sherwin-Williams. Debt to cap is a modest rate of 65%. The current ratio is low. I like to see it at 1.5 or higher. But the current ratio, which is the current assets divided by current liabilities, at 0.94. But I'm not too concerned there. Debt to equity is high at 3.5. You like to see it at 1.2 or lower. The current book to price ratio is at 16, which is pretty high, but it is lower than their 5-year average of 16.8. So that's a plus there. But it is high price to book ratio. You like to see 3.5 or 4 and lower. If we look at the future outlook for Sherwin-Williams, 2020 analysts expects earnings to be at $20. This is lower than 2019's earning of $21.12. However, they are expecting to grow earnings in 2021 to $23.25. And for the most part, analysts have over 90% accuracy in predicting these earnings. So I'm pretty confident in these earnings. CFRA has a 3-year earnings growth of 8%, and my dividend yield return model has a projected total return of 11.7%. This is real good. It beats my criteria of 9-10% or higher. So that's a positive there, and I see that happening. But we look further at the fair price and come up with a conclusion. So continue watching. The company has a current PE of 28, which is very high, and a forward PE of 27.8, with a 5-year PE average of 28.2. So based on this, it looks like the company is fairly valued. In a few slides, we'll determine the fair value price, but based on just the PE, it looks like it's fairly valued. Let's look at the fast graph. The black line is the monthly closing price. The blue line is a normal PE multiple of 24.6, and the orange is a PE of 15. As you can see here, this company tends to follow the black line, the blue line, excuse me. It tends to follow the blue line, the normal multiple of 24. So with the current PE of 28.2, so it's overvalued versus the normal PE multiple. So that's something to consider here. If we look at the projected earnings on 2022, we get $26.03. So from today's prices to that point, you have a projected total annual return of 4.9% based on a fast graph. So based on this, it looks overvalued. But in the next slide, we'll see, exactly if it actually is overvalued. But as you can see, earnings has been growing for the past 7 years. From 2013, it had a 15% growth rate, 18%, 27% in 2015, 21% 2017, 23% in 2018. So the company grows earnings very nicely. This is a company that I don't own, but I would definitely want to own this eventually. But we'll talk about that later. And as you can see, there's been times where the company was under the blue line, so under a 24 PE. I think those are where the opportunity to purchase shares will be most attractive. But let's look at the fair value price slide here. CFRA has a fair price of $543, Morningstar at $350, Fast Graph, as we just saw, at $572, Yahoo at $582, and my dividend discount model analysis at $633. The reason why I came up with $633 is because I used a 12% dividend growth rate for the next 3 years, seeing how they've been growing dividends at a higher rate for the past 5 years, and the most recent increase was 18%. So I was a little conservative at 12% for the next 3 years, and 9% after that with a discount rate of 10%. So that's how I came up with $633.36. Averaging out the 5, we get a fair price of $500.36, or $536.43, excuse me. And currently the company goes for $555. And that means it's overvalued, or you could say fairly valued, by 3.4% to our fair price. However, Warren Buffett says, it's better to buy a great company at a fair price than a good company at, undervalued or something like that. However, I have a recommendation as a hold for Sherwin-Williams. So I have a hold recommendation for Sherwin-Williams. This is a company that I've always had in my my watch list. I actually buy products from them. I go to their, my girlfriend does paintings, and she always buys Sherwin-Williams paints and whatnot. And when I paint my home, I use Sherwin-Williams paints. So it's a company that I buy from them, but I don't have in my portfolio, and I'm gonna have it eventually in my portfolio, but just not at today's prices. I love the dividend growth. I just don't like the dividend yield, but that growth rate definitely makes up for it. The low payout ratios dividend is very safe. The earnings growth is tremendous. It's actually that's exactly what you want to look for in a company when you invest in. The only thing I really don't like right now is just the valuation. I think anything with a PE of 22 or lower, 21 or 20, I think Sherwin-Williams would be definitely a buy. But at a PE of almost 28, I don't like that. I like to see a PE of 22, 21, or 20. Then I'll definitely open a position in Sherwin-Williams. And a PE of 22 gives us a price of $511. So I think $511 or lower is a great time to maybe purchase shares of this company. But I think this should belong in everyone's watch list, and be ready to purchase if it gets to maybe around $511, because if it does, it's going to be there for a very short time. So thank you for watching, and again, if this is your first time visiting the channel and watching this video, make sure to hit the subscribe button for tomorrow's next Dividend Aristocrat that I will be covering. So I'll see you guys tomorrow.